Well, hi, friends. Well, we're in the Thanksgiving season, and Donna and I wanted to especially express our thanks to you. The ministry can only happen because of your prayers and your gifts. So you give, and we get to minister. Now, today, what I want to do is to try to give back a little bit. Some of you know that back in 2012, I worked for a wonderful organization called Wealth Financial Group West. And my boss there, Tami Simpson, is a certified financial planner. She's a fiduciary. And everything that she did there was with the client's best interest in mind. I've asked her to join me today because there's an awful lot going on with taxes. I mean, I'm really encouraged by the fact that our president has, what did he hire, 800 and some FBI agent, tax IRS people. And so if there are ways that you can do the giving maybe a little bit better than what you've been doing, I certainly wanted to make you aware of that. So I wanted to welcome my friend Tami. And Tami, let me start off by saying, what's the national debt up to now? When we worked together, it was 22 billion, and we looked at that and we said, unbelievable.
Yeah, and Brian, I haven't looked for a while. Have you looked?
No.
It's, yeah, the debt, the gap, the deficit, they're all so huge and they're all different, right?
Mm-hmm.
So we have the deficit, that's what we run short every year. We have the gap, the fiscal gap, that's what we have committed to over the next, decades that we don't have any money for. And then there's the debt that we've already accumulated, and they're just all bad.
Yeah.
They're just all bad.
And those of you who are supporters of our ministry, most of you are in or nearing retirement. And that produces a real problem in the fact that you've got somewhat of a fixed income. And having a fixed income, I know what Tami and I worked on when I was working with her was there were two ways to increase the bottom line. One was to increase how much you have coming in, and the other way was to decrease how much you have going out. So we're going to focus on how much you have going out and what you can do to reduce that.
Mm-hmm.
So the tax problem for seniors, let's give them an overview.
Yeah, well, there's a lot of things that threaten retirement income, and retirement income, retirement inheritance, all of it. I think that some of the things that come to mind always are market losses, unexpected medical, reductions in benefits. These are the things we traditionally think about happening that could threaten a retiree's welfare financially when they retire and are on that fixed income. I have said for many, many years, almost 2 decades now, that actually the thing that threatens retirees' income more and their family wealth is taxes. I think everybody's focused all the time on markets, and certainly right now we're focused on markets, right? Markets are doing, challenging things that make everybody bite their nails. Everybody always has in the back of their mind, I could have a long-term care or a medical need that kind of haunts me. But what people don't focus on are things like taxes and then inflation. Obviously, inflation is a tax in a whole different way, right?
Yes.
And right now, we're experiencing kind of this perfect tax storm where lots of things are coming to bear on retirees who have usually a rather fixed income, or at least they've set themselves up on a fixed income because they're taking withdrawals from various things. And they've figured out what those withdrawals need to be able to pay their bills. And that is not working very well right now. As everybody knows, every single thing they're doing is costing more. So they're needing to take bigger withdrawals. They're needing to take larger distributions, even if it's not a required distribution, just to get by. People are needing to take bigger distributions. And most of people's retirement savings is in a tax-deferred account. And so a tax deferred account is where they have to turn to take those larger withdrawals to pay for those more expensive groceries and higher tax bills and higher gas bills and utility bills. So maybe they were able to take a distribution of $3,000 a month to add to their Social Security and maybe some other sources of rent or other income. But now maybe they're needing to take $4,000 or $5,000 a month out. So now you're going to have a higher income that is taxable. So not only do we have to take out more to keep up with our costs, but then taxes, as we know, taxes have to go up because just like you said, Brian, at the top of when we started to talk, you just cannot hand out dollars and continue to have the gap, the deficit, and the, you know, debt build and not keep printing money. You just can't do this. Ultimately, the only source of revenue to pay that off is the taxpayer. So as people age and have to take larger distributions, even if it's just to keep up with inflation, but then add in required minimum distributions, maybe you have enough cash flow, but you are still required to take distributions out of these tax deferred accounts, put it on top. And then we haven't even, you know, talked about the fact that this is what you worked your whole life to accumulate, and you'd rather it go to where you want it to go to than the government. So you'd rather it go to your church, your charity, your ministry, your alma mater, your kids, than to go to the government. And so taxes are just an enormous challenge to moving forward.
You know, some of the people that are supporters of ours are not retired yet and may not even know what required minimum distribution is. So,
Okay.
you know, we've had all these years to accumulate money and it's been tax deferred. And isn't that wonderful that the government did that? Isn't that wonderful? However, there's no free lunch, is there?
No free lunch. In fact, the lunch is more expensive as time goes by. You're just putting off the lunch bill, right? And so, yes, if you are not yet retired, you are familiar with taking money from your income and moving it to your 401k or your 403b if you work for a church or a ministry or a nonprofit, and you remove it this year from your taxable income and you don't pay taxes on it. So when you do reach now the age of 72, which was a recent change, the government is tired of waiting to get their taxes, and they're happier now because your account is bigger, hopefully, and it's grown. And so now the tax bill is bigger also, right? Which is why if you are in that still accumulating phase, you want to look at some ways to shield your future tax bill, maybe pay your taxes now, depending on what your actual income is. But yeah, at 72 now, we have what's called a required minimum distribution. And that is just simply where you have to add up the money that you've saved in tax deferred accounts. And the government has a divisor that each year, based on your age, you have to divide your total tax deferred accounts by that divisor. And then that has to be withdrawn, added to your other taxable income, and taxes have to be paid on it. And you don't have to spend it, what's left, right? After taxes, you can save it, or, you know, spend it or invest it or whatever you want. But it's just about saying this tax deferred pocket over here on this side, the money has to come out, pay the tax bill, and it can now go into this after tax pocket, which is just like my paycheck. I get my paycheck into this pocket pre-tax, I pay my taxes, and now it goes into this pocket, right? And so it's just, we've put off the tax bill. We have kicked the can down the road. Also, used to be a good idea, not so much a good idea anymore, particularly because most of us in this industry do believe that taxes are going to go up over the next 5, 10, 15, 20, 25 years. And so while it feels good to lower your tax bill now, it may not be in the future best interest of you and the rest of your extended family or churches or charities who would ultimately get your wealth at your, you know, when you pass.
You folks that are watching this video, you're viewing it in my newsletter, and just below where you're looking, there is a little button that talks about the RMD, and it's a calculator put out by AARP, and it will give you an idea of what the taxable income that you've got to pay the government actually is. So I invite you to take a look at that. Okay, Tammy, so we've got to do the RMDs. And what are the tax advantages for people who give to charities?
Well, so, first of all, too, Brian, I think you and I both need to say that we're not giving anybody individual tax advice right now, because if there's anything more complicated than taxes, I'm not certain what it is. I'm not even sure brain surgery is more complicated than taxes. So not giving specific tax advice, but want to give you some general ideas about taxes that you may not know of or have heard of. And then you certainly want to work with whoever does your taxes to see how they would best apply to you. And Brian, what specifically, you asked me a specific question. I want to make sure I address
what I want folks to get an understanding of is this government regulation that allows for qualified charitable distributions.
Okay, yes. So as you know, you have, let's say that you have a charity, and like the one that you are involved with, Brian, or you have
that one. Yes.
Remember that one.
No,
That's right. Or you have an alma mater, or you have a church, or you have a synagogue, or, I don't know, the Boy Scouts, or, a university. Let's say that you are supporting something that is meaningful to you, and you want to enhance their impact on the world. So there's multiple ways financially to do that, right? One is you just write them a check. Now, the advantage, one of the benefits of doing that is you get a tax deduction, right? So, and those tax deductions do often have to do with what is your adjusted gross, and there is limitations to how much of a deduction and how much of that deduction. Let's say you give $100,000, and that might sound like, well, nobody does that, but people actually do. Doesn't matter if it's $5, $10, or $100,000. It just doesn't matter. If you're going to give it, sometimes there's going to be limitations on what you are allowed to deduct. And then there are benefits. Obviously, a tax deduction means that came off my taxable income, right? So if I give 10,000, then 10,000 can come off my adjusted gross income, which is the amount I pay taxes on. Oh, good. Well, I didn't pay taxes on that 10. But there is a way that a lot of my clients use, Brian, that is allows the ministry to receive more money. And that would be, let's say that I want to give $10,000 to your ministry. And I write you a check and I get a deduction. And so then maybe after the deduction, I get $500 or $1,000 back on my taxes, right? So I gave you 10, but it really cost me, let's say 9. Okay. But there's another way to do that. If I have money in a tax deferred account that I'm going to have to take out and pay the tax bill because of an RMD, or when I die, my kids are going to have to pay the tax bill on it, I could give the ministry 10,000 directly from it. Doesn't come to me and then I give it. It goes from wherever my IRA or tax deferred account is held directly to the ministry and what's called a QCD, a Qualified Charitable Distribution, trustee to charity. Okay, doesn't come through me. Nobody pays taxes on that money now. I don't pay taxes. The donor doesn't pay taxes. The charity doesn't, that receives it, the ministry doesn't pay taxes. The government gets 0 of those dollars. 0. Okay. So I think, and I have people who do this. I have people who pay tithe. I have people who pay to their synagogue regularly, or a university, and they And they do this with not large amounts. We're not just talking big donors, right? Certainly if you are a larger donor, this can have other ramifications because, as you know, when you take these RM, or maybe you don't know, when you take a required minimum distribution from your IRA and you have to do it and your spouse has to do it, you both probably have these, those are considered income. And as you know, your Medicare benefits and what you pay for your supplements can be tied to what your income is, right? And so if your income, if you're like on the line between, one tier of those costs and the next, that can bump you. I've had people be just astonished that they took their first RMD and went, whoa, wait a minute, my Medicare just went up, right?
Yeah.
Why is that? And how do I avoid that? You can't, because that RMD is just considered income. And there can be other ways, like when the government was sending out checks during COVID, some of those checks were income related, right? Mm-hmm. So an RMD could have pushed someone out of receiving that check. And it's actually a very clean and smooth way to donate also, right? You don't have to get it, file it, keep record. It's a much different, experience also. So it can protect things that are tied to your adjusted gross income. And in effect, it can keep no dollars from that going to the government. Not that I'm opposed to the government getting some money, but right now I'm not really too impressed with how they're handling all this money.
Good reason.
I'm willing to pay for roads and an army and things, but it seems that we've crossed a line.
Right. Yeah.
What they're doing.
Yeah, these QCDs also have an impact on inheritance.
They do. And one of the things that I think people might want to think about, so often people look at their 401k or their 403b or their rollover IRA, whatever their SEP, whatever their tax. I have a mom who has a fairly large 403b. She worked for a nonprofit for a long time. And we look at that statement. Let's say that you have a 401k and you look at that statement and it has 450,000 in it, and that makes you feel good. We like that. Wow, I have 450,000, but you don't. That isn't your money. Brian, back in the day, you and I used to talk about how if those statements came to people, and in the corner of their 401k statement, it said the joint account of Brian Horning and Uncle Sam, we would look very different. And it's a joint account where your joint owner of your account is Uncle Sam, who decides each year how much of the account is his. I mean, that's quite a business to be in, right? If I could find a business partner that would let me earn all the money and then every year decide how much of the business was theirs, that'd be kind of interesting. So, we look at that account and we go, oh, I have 450,000 in my IRA or my 401k. You don't. I do this all the time for clients. You're going to take out we call these tax infested accounts, because you're going to take out an RMD. You're going to be forced to take out an RMD at the age of 72 now. We think that age will change, but for now it's 72. When you take the money out, you're going to pay taxes on it. Now, if you don't spend it, you're going to resave it or reinvest it. It will make some interest. You're going to pay taxes on the interest or the growth of the, money after you've paid. Now your kids, if you don't spend it all, they're going to inherit it. Now the stretch IRA is gone. So if you don't know what that is, Brian probably does, and he could tell you about that. But the stretch IRA used to allow our kids to stretch the tax bill on the money they inherited from us that's tax deferred over their lifetime. They can't do that anymore. That was part of the Secure Act. And now they have to withdraw that all within the first 10 years and pay the tax bill. Okay. And those numbers are included in your estate tax for estate tax purposes. So those are 4 taxes right now that directly apply to these tax deferred accounts. So you see a statement that says 450. I look at it as a financial advisor and see a statement that's just 250. Really, that's really closer to what everybody's going to get out of that account. So if you want to make contributions, the best money to contribute to a ministry or a charity is these tax deferred accounts. You know, I have clients who come in and say, you know what, I do want to leave money to my kids. There's no question. I don't want to leave nothing to them, but I'm not going to leave them these tax deferred accounts. That's not going to benefit them. They're going to end up paying, you know, a third or a half of this to the government. I'm going to leave my tax deferred and transfer it while I'm living to the church and charity or ministry that I'm passionate about. That's going to be my legacy there. I'm going to leave my other assets that step up in value, my non-qualified after tax investments, my house, you know, my jewelry. Those are the things that I'm going to leave to my kids, and I'm going to bless. Because I mean, if you think about this, if you've got $100,000 in a tax deferred account, and over your lifetime and your kid's lifetime, 50,000 of it's going to go to taxes. And again, I want to say, I'm not giving anybody specific what's going to apply to them, but a lot of it, a chunk of it's going to go. Why not just give all of that to the charity or the ministry, so that the government doesn't get even a third of it or 25% of it, right? So yeah, Brian, that's a big deal, I think, because I would so much rather choose who gets that money than to just have it go into the big ether of, you know, whatever they do with the money they've received from us.
Well, Tami, I want to thank you for the time that you've given us. There's so much information that people need to know. Go ahead.
Well, I was just going to say, people might be saying, well, how do I do that? It's not hard to do a QCD, that qualified charitable distribution. You just, Brian, you know how to do it for your ministry. I'm sure they can just say to you, hey,
yep,
I want to do that QCD. Every ministry I've ever been associated with knows how to do this. So you just contact them and you say, I want to do this. How do I go about doing it with you? And then you work with your trustee currently of your account. You have to do the paperwork correctly, have it go directly to the charity. It can't come to you first. And it's not difficult to do at all. And if you're questioning, well, is the ministry that I or the church or charity or whatever, you just ask them. Say, hey, you know, are you a nonprofit and can I do a QCD with you?
Yes.
And so it's not difficult to do. In fact, I think in some ways it's easier than some of the alternatives.
Right. And Standing Stone Ministry is equipped to do that. So it's a very simple process. I just wanted to make you folks aware of the fact that it was there. And for some of you who are, you know, writing a monthly check, you may want to consider doing it through a QCR or QCD. And for you, it's, you know, you're doing exactly the same amount, but it's benefiting you on tax day. Well, Tami, I want to thank you for giving us the time. If one of my donors is interested in getting some more information and they'd love to maybe contact you, how would they do that?
Yeah, if they have any questions about it too, they can call me. So, you know, you can go to wealthfinancialgroupwest.com. That's, you know, an easy way. I'm sure they can get contact information through you, but it's Wealth Financial Group West. That's the name. I'm in Costa Mesa. Phone number here is 714-617-4394. Also, you can email me directly at Tami@wfgwestinc.com. But yeah, if you just have a question, shoot me an email. I'll be happy to, you know, to answer any questions that you have. And any way that I can help you, Brian, in your ministry, you know, I stand behind you guys all the way. doing great, great work.
Thanks, Tammy. Thank you. I will post Tammy's information in the newsletter. And again, have a wonderful Thanksgiving. Tammy, I pray that it's a great, great end of year for you. And again, thank you for doing this with us.
You're welcome. Have a great, great holiday season, everyone.